Welcome to the Riskwiser Zone. I'm your host, Louie. Today, we're diving into the world of artificial intelligence and its impact on the stock market. We've got a fascinating story to share with you, and it's all about finding stability in a volatile industry. As we explore the AI landscape, we often come across companies that are leading the charge in innovation, but may not necessarily fit the bill for retirees or income-oriented investors. They're often high-growth, high-volatility stocks that can be challenging to navigate. However, there's one company that's been flying under the radar, and it's caught our attention. Cisco Systems, a well-established player in the networking space, has been quietly building a significant presence in the AI infrastructure market. With its Silicon One networking silicon, 1.6T and 800G optics for AI clusters, and a growing portfolio of AI-specific switching and security products, Cisco is becoming a major arms dealer for the AI data center build-out. What's interesting about Cisco is that it offers a unique combination of stability and growth, making it an attractive option for retirees or income-oriented investors. The company pays a meaningful and growing dividend, generates substantial free cash flow, and has a regular share repurchase program. Its fiscal 2026 revenue guidance was recently raised to roughly $61.2 billion to $61.7 billion, with management citing double-digit order growth across geographies. Now, you might be wondering why hyperscalers, which build much of their own infrastructure, would buy as much as they do from Cisco. The answer lies in the company's incumbency, reference architectures, and supply commitments that few competitors can match at the volumes required. While Cisco may not offer the same level of upside as some of its high-growth counterparts, it provides a unique bargain for investors seeking AI exposure without sacrificing stability. With its predictable free cash flow, accelerating AI revenue growth, and reasonable valuation, Cisco Systems is definitely worth considering for those looking to balance risk and return. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. Today, we're taking a closer look at the rising costs of living and how it's affecting American families. You've probably noticed that your dollar doesn't stretch as far as it used to, and you're not alone. Recent data shows that inflation has outpaced wage growth, leaving many people feeling like they're slipping backward. We spoke with financial expert Angela Hanks, who notes that people are looking at higher prices across the board, and their dollar is not carrying them as far as it previously was. One Florida mother, Kiana Powell, is trying to make ends meet for her family of 5. She's having to get creative with her grocery budget, using digital coupons and shopping during sales to stretch her dollars. It's a story that's all too familiar for many Americans who are struggling to keep up with the rising costs of food, housing, and energy. Now, some of you might be wondering what's driving this inflation. Well, according to economists, surging energy prices are playing a big role. Gasoline prices jumped over 28% last month compared to the same time last year, and those higher fuel costs are seeping into the price of consumer goods. Add to that tariffs on imports, and it's no wonder people are feeling the pinch. But what does this mean for the average household? Will we see a pullback in consumer spending, which could lead to lower economic growth? That's the question on everyone's mind. Former Federal Reserve Chair Jerome Powell warns that, in the near term, higher energy prices will push up overall inflation, but beyond that, it's uncertain. As we navigate these uncertain times, it's essential to stay informed and plan ahead. Whether you're a seasoned investor or just starting out, understanding the economic landscape can help you make smarter financial decisions. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a look at some global economic news that caught our attention. We've been following the developments between China and Russia, and it seems their trade relationship is becoming increasingly important for both nations. with trade standing at $228 billion in 2025, down 6.9% from the previous year. According to Chinese customs data, it's clear that there are complexities at play. Russia has ramped up its exports to Asia, particularly natural gas, which it sells to China at about a third less than the price paid by Europe. This shift in trade dynamics is significant, especially considering Russia's gas sales to European markets had been largely cut off due to the war in Ukraine. The forecast suggests that annual eastbound flows could reach 52.5 billion cubic meters in 2029. Meanwhile, China sees Moscow as a useful partner in advancing its multipolar world order ambitions, but is cautious not to become too closely identified with the risks associated with Putin's actions in Ukraine. This delicate balance reflects China's strategy of maintaining its relationship with Russia while presenting itself globally as a force for stability. In other news, Taiwan Semiconductor Manufacturing Company, Limited (TSM), has been making waves with its predictions about the global semiconductor market, expecting it to surpass $1.5 trillion by 2030. Driven by AI, high-performance computing, smartphones, and automotive applications, this growth underscores the significant role technology will play in shaping our economic future. As we consider these developments, it's essential to approach investments with a nuanced perspective, acknowledging both the opportunities and risks inherent in global trade and technological advancements. Whether you're interested in the geopolitical implications of China-Russia relations or the potential of semiconductor stocks like TSM, it's crucial to stay informed and adapt your investment strategies accordingly. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.